Welcome back to The Explainer. All right, let's just dive right into this, shall we? Today, we're basically putting on our hard hats and stepping right onto the construction site of corporate finance. We're going to be looking at a fast-paced, step-by-step blueprint for mastering what is honestly one of the most mechanically complex areas out there: corporate group accounting and consolidation. We're taking all those scattered building blocks, the parent companies, the subsidiaries, fair values, unrealized profits, and we're going to show you exactly how they all fit together to form one unified, consolidated economic entity.
But hey, before we actually start building anything, we really need to talk about the stakes here. If you're studying for your ACCA exams, particularly financial reporting or strategic business reporting, you absolutely need to hear this harsh truth straight from the examiner's notes. Quote, "If you cannot consolidate, you cannot pass." End quote. Wow. Group scenarios are literally guaranteed to appear. But here's the good news. Consolidation, it's a highly logical, highly repeatable process. Once you actually see the underlying structure, what looks like this chaotic mess of numbers just becomes a totally predictable, completely solvable puzzle.
So, here is the builder's blueprint we're following today. 1. Defining control under IFRS 10. 2. Goodwill and business combinations. 3. The basic consolidation recipe. 4. Mastering fair value adjustments. And finally, 5. Cleaning up unrealized profits.
Okay, starting off with Section 1, Defining Control under IFRS 10.
Listen, before we go combining any financial statements, we have to lay down the rules of the game. We have to know if we even have the right to build this consolidated house in the first place, right? So the absolutely crucial starting point is answering this: when does a parent truly control a subsidiary? Now, for decades, the easy answer was just, owning more than 50% of the voting shares. Done. But today, modern corporate structures are way more complex than that. You can own a massive majority of shares and still not actually call the shots. Or conversely, you can own a minority of shares and basically run the whole show. Standard setters realized pretty quickly that they needed a much more robust definition.
And what they came up with are the 3 pillars of control. Under IFRS 10, you literally must have all 3 of these structural supports firmly in place if you're going to consolidate. First up, you need power over the investee, meaning you actually have existing rights that give you the ability to direct the relevant activities. Second, you need exposure or rights to variable returns, so your financial outcome is directly linked to how the subsidiary performs. And third, the ability to use your power to affect those returns. Now look, yes, having over 50% of the voting rights is usually the most obvious indicator of these 3 pillars, but as an accountant, you have to make absolutely sure all 3 are completely rock solid before you consolidate.
Moving right along to Section 2, Goodwill and Business Combinations under IFRS 3.
Okay, so once control is a sure thing, we move into the materials phase of our blueprint. The parent company has gone out, they've bought the subsidiary. But here's the thing, they almost always pay a premium over what the subsidiary's individual assets are actually worth on paper. That premium, that's what we call goodwill. To calculate this, we just use a straightforward math stack. At the top, we take the consideration transferred. That's the cash or the shares the parent actually paid. We add to that the value of the non-controlling interest, the minority shareholders' piece of the pie. Together, those 2 numbers represent the total implied value of the entire subsidiary. Then we just subtract the fair value of the net assets acquired. The difference, that leftover premium at the bottom, is our goodwill. It represents the value of the brand, the customer lists, the synergies, basically the invisible magic of the business.
But watch out, because right here is an absolute classic trap set by examiners. Notice how we value that non-controlling interest, or NCI? Well, you actually have a choice. Under the full goodwill method, the NCI is measured at fair value, which is often just based on the active market share price. This means the NCI gets its own little slice of the goodwill pie. But if you're using the proportionate share method, the NCI is strictly measured as their percentage of the net assets only. Period. No goodwill is attributed to the minority. Getting this wrong will fundamentally warp your entire goodwill calculation, so always double-check the specific policy being used.
All right, on to Section 3, the basic consolidation recipe.
The foundation is poured, the materials are on site. Now it is time to frame the house. This is the moment we take the separate financial statements of the parent and the subsidiary and fuse them together into a single economic entity. Think of this core mechanical engine kind of like an offensive playbook in sports, okay? It's a high-speed 4-step drill. Step 1, we sweep across the board, adding the parent and subsidiary's assets and liabilities together, line by line. Step 2, we literally cross out the parent's investment in subsidiary line item because, you can't be invested in yourself.
Step 3, we drop in that Goodwill figure we just calculated. And Step 4, we make our granular adjustments for fair values and unrealized profits. Just like that, the separate entities vanish and the unified group emerges.
Which brings us to Section 4, Mastering Fair Value Adjustments. Let's drill a bit deeper into that final step. Remember, when a parent buys a subsidiary, they don't just magically adopt the subsidiary's old historical book values. No way. They have to revalue everything to its fair value right on the date of acquisition. And guys, this creates a massive ripple effect. Seriously, if you remember absolutely nothing else from this explainer, remember this golden rule punchline. Fair value steps up assets, extra depreciation eats into post-acquisition profits. I'll say it again. When you revalue an asset, like say a giant factory, upwards on the day you buy the company, that larger asset value is absolutely going to generate larger depreciation charges in the years to come.
So this creates a really interesting dual effect. On day 1, at acquisition, it's strictly a balance sheet adjustment. You increase the subsidiary's asset value to its true fair value, which conversely affects your initial goodwill calculation. Super straightforward. But the real tricky part is post-acquisition. Years later, you have to calculate the extra depreciation on that fair value uplift and then deduct it from the subsidiary's retained earnings in your consolidation workings. It's this sort of creeping profit and loss impact that examiners just love to test you on.
Okay, final stretch. Section 5, Cleaning Up Unrealized Profits. We have finally reached the last coat of paint on our house, hunting down and eliminating hidden unrealized profits. This is absolutely crucial for getting the true value of the corporate empire. The golden rule of a single economic entity is that you cannot make a profit by selling things to yourself. I mean, think about it. Imagine you move a flat-screen TV from your living room into your bedroom, and then you charge yourself an extra $100. You aren't actually any richer, right? It's the exact same concept here. If the parent company sells inventory to the subsidiary for a profit, and that inventory is just sitting there unsold in a warehouse at year-end, well, that profit is unrealized. We have to strip that inflated revenue and the fake profit right out of the consolidated statements.
But here is the massive aha moment that trips up so many people. Who actually takes the hit for that elimination? Well, it entirely depends on the direction of the sale. In a downstream sale, so the parent selling to the subsidiary, the profit was obviously made by the parent, so we eliminate 100% of that unrealized profit straight out of the parent's retained earnings. Simple. But in an upstream sale, where the subsidiary sells to the parent, the profit was made by the subsidiary. And because the minority shareholders actually own a piece of that subsidiary, eliminating that profit hits the subsidiary's retained earnings and proportionally reduces the non-controlling interest. You see? Upstream sales are super dangerous because they directly impact the minority.
So, look at that. We've built the house, we've defined control, calculated the goodwill premium, consolidated the lines, adjusted the fair values, and scrubbed out all those fake intra-group profits. We've officially mastered the mechanics of building a group. But I'm going to leave you with a bit of a provocative thought here. What happens when it's time to tear the house down? Like, what actually happens to the consolidated balance sheet, the goodwill, and the non-controlling interest on the exact day the parent loses control and disposes of the subsidiary entirely? That whole process of deconsolidation is a completely new puzzle, and honestly, a perfect topic for our next exploration. Keep studying the blueprint, and I'll see you in the next explainer.